Listeners, welcome to Tales of Abundance. Today's abundance briefing is going to be a little bit different. I am here with Dr. John and with Anthony, but we have a guest coming up shortly. One of our best performing episodes ever was when Jim Lynch was on at the beginning of the year, right after the election, making some predictions. And during the episode, we talk about some of those, but I do want to give people, just so you understand where he's coming from. So some of the things that he predicted, and this is an AI summary, but long-term bonds will underperform badly, was one of his predictions. Well, that's continued to happen for the last year. He predicted that there will be a major financial crisis, or didn't predict, he said there's a good chance that we'll have a black swan event. Some kind of serious black swan. That has not happened, and he specifically predicted it was hedge funds, but it's only been a year or 10 months, so it certainly could be coming. The prediction. His other prediction is that the Fed Treasury will not allow a prolonged stock market crash, and I think that's really true, right? Well, the economy hasn't necessarily been in the best shape. The market's up 20%, so they're going to fight interest rates and all that. He definitely did that. Anthony, John, you guys got any comments on any of these that you want to add in on those first three at least?
For people listening to the first episode, for this upcoming episode that we're about to release is, to me, much more actionable. Like, to me, we were able to get more into the what does it mean, how do I take action? And there's a lot of things that went over my head, but I was able to get Jim to really kind of bring it down to my level. I appreciate it. I think the listeners are going to enjoy.
All right, that's great. Listeners, we will talk to you after the break, and we'll be back with Jim Lynch. Listeners, welcome to Tales of Abundance. As always, I'm here with Dr. John and with Anthony, and we have a special guest back today for his second time on the show, Jim Lynch, lifetime bond trader, and we are going to get into the state of the economy. So, John, I know you got lots of questions for Jim. I'll turn it over to you.
Well, it is a super interesting topic for me because I'm probably the least knowledgeable on these sets of topics for you, me, and Anthony. Like, I know the least. I'm super interested in personal finance. I'm super interested in, like, how do I grow and protect wealth for my family? Like, those are interesting topics for me. But Jim, I think, from your perspective, you're starting your 40th year in the bond market next year. Super exciting. Maybe. We'll find out more about that in a minute or two. So you've got a lot of experience here. And, for a guy like me who's like I've been following personal finance for a long time. It's never been a profession of mine. There's lots of information that I could listen to that and be really scared, too scared. I could be really optimistic, too optimistic. But giving people a real sense for, like, this is the lay of the land. These are the choices you're faced with. Different people will make different choices based on what they think is best for their individual situation. We're not giving financial advice today because we're not anybody's financial advisor. But, like, it's an interesting place to start. And Anthony, you and I were talking before the show. Like, you had a couple places like, hey, let's kick this thing off from the very beginning. So do you want to ask your question now and just jump right into it?
Yeah, sure. In your first episode, you talked about a meeting you had, or an engagement you had with two University of Texas students who either recognized you or somehow divined that you were an expert in finance and bonds and what have you. And after they asked their questions, you told them, you said Bitcoin.
Yeah.
And it was one word, that was it. And so here we are 10 months, 11 months later. Life has been a bit tumultuous in terms of, Liberation Day and Bitcoin's, tremendous rise and fall. I won't call it a fall, but, readjustment, if you will. If you met those two students today, would there be more than one word, or
No.
how would you approach them?
Same way.
Okay,
Same way.
So the belief is the future is Bitcoin. All else in my portfolio is of no use.
No, I wouldn't say that. I wouldn't say that at all. And we're going to get into this.
Okay.
Let me first start off by saying welcome, everybody. And yes, Dr. John noticed I have my Christmas sweater on. And it is December 8th. Merry Christmas. Happy New Year. I hope everybody had a Thanksgiving. Anthony
Oh, hold on.
reference.
Your sweater says all I want for Christmas is Bitcoin. You can't see
Oh,
it.
okay, yeah.
There it is. All I want for
Uh,
Christmas is Bitcoin. Of course, I would
okay,
expect nothing less from Jim. But go ahead.
all right. First of all, nothing you're going to hear today is financial advice. I am not representing any financial firm, not even my own. I'm here because I'm friends with these three gentlemen. I like their podcast, and I think I could offer some help. So the story that Anthony is referencing is a few years ago. I was walking down 2nd Street in downtown Austin, and these two kids from UT stopped me and asked me if they could talk to me, and I said sure. And they said, what would your advice be to two college kids coming out of any college, but obviously UT being here in Austin? And I said, look, there's two things I would do from the get-go. Just get in this habit. I said, save 10% of your income and tie 10% of your income. And they were recording this, and they thought that was pretty interesting. And, they said, anything else? I said, yeah, you want to be your own boss. You want to be your own entrepreneur. And they thought that was really great. And then I said, and then they appeared to stop the recording. I said, well, let me rephrase this. If you could allow me, 30 more seconds. And, and let me say this. I hear a lot of talk on Twitter, X, any social media website. And the big thing I hear these days, everybody picks on boomers. The boomers have had it so great. The boomers this, the boomers that. I'm a boomer. I'm right in the middle there. Every generation blames the prior generation. It's happened for thousands of years. If they didn't do this, if they didn't do that. And, the boomers have had this great 40-year run. Well, let me tell you how it was growing up as a boomer. In the early 1960s, we were doing air raid drills because we thought we were going to have a nuclear war with Russia. I don't think there's any issue with that today. In 1963, President Kennedy got assassinated. In 1968, his brother got assassinated. Then Martin Luther King. So by the time we got out of the 60s, most of us didn't think we were going to live really that long in life because everybody just killed each other. And in 1965, we went to the Vietnam War. Go read your history books. Tell me how great of a war you thought that one was. Oh, and by the way, when we went to buy our first home, interest rates were at 15, 20%. I bought my first house at 13%. And if people are complaining at 7%. I was double that. My buddies and I in the early 80s, we never thought we would buy a house. I'm hearing the same lingo today. I'll say this to any Generation Z, any millennial out there. I'll swap. You take my money, you take my age, 68. I'll take being 25. And the reason I would make that trade in a heartbeat, because you guys got the greatest investment in the world at your doorstep. Don't take advantage of it. It's okay. And what I told those two kids from UT, just buy Bitcoin. That's all you need to do.
Jim, that's not a Bitcoin message. That's a message that's as old as age, like time itself. Like youth is wasted on the young. It's true. I mean, I think every generation has said that, right? Like, I think most generations would say, with what I know now, I would go back and do it. That's fair. Like,
yeah. Look, now, to answer Anthony's question, like, is it only Bitcoin? Obviously not. Now, are there some people putting all their money in Bitcoin? Like, there's people who put all their money in gold. There's people who put all their money in stocks or all their money in bonds. Look, look, I'm not here to tell anyone to do that. But, most people, if you look at most of your listeners out there, the average portfolio for most people is 60% equities, 40% bonds. And I'm here to tell you, the 60% is great. It's the 40% that's broken. Okay, and look, since the pandemic, long-term bonds are down 40%. Does that sound like the largest, most liquid, most safe investment in the world to you?
Let's stop there real quick.
Go ahead.
Because this is perfect. This is perfect. Most of us, most of America, has a pretty clear understanding of the stock market. They
Right.
hear every day, it's up, it's down, or whatever. But the bond market is to me like looking through a fish tank. You can kind of see the other side, but you don't really understand what's going on. Explain what has just gone on with the bond market when you say the bond market went down, and why you think going forward it's not going to be the best possible use of your excess capital.
Great question, Anthony. We did cover a little bit of this with the bond market in part one of our discussion. So I don't want to repeat everything we said there. I mean, in our last discussion, very apropos, was at the end of February. I think the first 45 minutes was predominantly the bonds and why they go up and down. But what's the issue? The issue is this. From 1900 to 1980, we had a bond bear market. For 80 years, you lost money in bonds. What do I mean by losing money? That's just that. You lost money. You didn't make money in bonds.
So hold
Go
on,
ahead.
Jim. So you're a bond trader, 40 years.
Yeah.
You made money selling and buying bonds. You're saying if I bought bonds and just held them the whole time, I lost money?
You lost money.
But you
From
could
the-
actually make money in bonds. I mean, you made money in bonds for 40 years.
Traders will always make money. Okay? It's not the traders I'm talking about. I'm talking about the individual investor.
Got it.
Go back and look at the charts. 1900 to 1980 was a bond bear market. From 1980 to 2022 was a bond bull market. You made money in bonds. Now, do I mean every year over those 80 years? No, but from those 80 years, if you look at 1900 to 1980, you lost money. From 1980 to 2022, you made money. Well, what happened in 22? Well, the Fed started raising interest rates, and you basically had been losing money in bonds since. So that's the issue with bonds. Now, I know, and Anthony brings up a great point, because you'll turn on CNBC or Bloomberg or Fox Business or CNN, and you'll watch them for an hour, and you're going to get 58 minutes of equity news and 2 minutes of bond news. And it's very confusing. But yet, the bond market is basically driving the bus here. And that's what most people don't realize. They think they just buy a Treasury bond or a muni bond or a corporate bond and everything's hunky-dory. No, we have a debt issue in this country. We have a debt issue in the West. Even China has a major debt issue. And we cannot kick the can down the road anymore. We're at that precipice now where, is it going to happen tomorrow? Is it going to happen 3 months from now? I don't know. But we can't kick the market. We can't kick the can down the road anymore, because we are in a situation that is known as fiscal dominance. What's fiscal dominance? Fiscal dominance is when your fiscal situation drives the bus. And that's what's happening in the market. 6 times over the last 6 years, the Treasury market has blown up, and 6 times the government has come in to add liquidity. Full stop. This is what I think they're going to do. This is what I thought they did. This is basic math. The Fed has a mandate. Low inflation, high employment. Well, that's out the window now. If that Treasury market's not functioning with $40 trillion in debt by the end of the first quarter, they got to do something. You
Okay,
want proof?
So
Go
the
ahead.
normal person, though, what this looks like, because this, like, I'm insulated from this maybe in terms of feeling the impact. So I think what this means is this stuff's happening. So what's happening is it looks like, in some ways, GDP growth is what's being reported to me, which sounds good.
Yeah.
But really, what's also happening is this kind of inflationary curve that's happening because more money is being printed, which seems great to me because maybe I'm getting a pay raise or what these other things maybe, right? Or I'm charging more in the marketplace. But what might be happening, that people don't recognize is that that inflationary period is actually creating less purchasing power for me, because eventually I mean I trade my expertise for money in the marketplace. That's how I make money. And over time that purchasing power either goes up or down. So while it might feel good to make more money, the truth is that it may have cost Anthony, I think, Anthony, you probably bought your first house for $30,000 or $60,000. I bought my first house for $200,000, and my kids will buy their first house for $600,000. And the real issue isn't the number of dollars. The real issue is how much of my earnings potential, what percentage of my earnings potential am I paying for that house, and that has to be normalized against inflation, right? Like that's the part of the equation that we're being kind of lulled to sleep by, right? Or am I wrong?
No, you're 100% right, John, and this is what most people don't understand. So you're essentially talking about what Jamie Dimon called 2 months ago the debasement trade. What is the debasement trade? Okay, well, let's just talk since the pandemic. It's been almost 6 years. In US dollar terms, the NASDAQ is up 165%. So far, so good. I'm feeling great. The S&P is up 102%. Home prices are up 55%. Everyone's happy, right? You should be happier than a pig in mud. Well, but when you look at it in gold terms, the NASDAQ is up 7%, the S&P is down 18%, and home prices are down 37%.
So hold on, back up. So for me, what that means is that like my real rate of return, so like the return minus inflation's impact, right? So not we're not taking the return that's reported versus the reported inflation, because reported inflation is debatable, and we could argue both sides of that.
Yep.
What we're really talking about is buying power, right?
Buying power, purchasing power. So now
What does it mean? What
go.
does it mean? What does it mean in gold terms?
in other words, if
Explain
I priced, let me finish and you'll see it. So now let's go to Bitcoin. Now I know Bitcoin is backed up a little bit. This chart is from a couple of months ago, so it's not as good. But in Bitcoin terms, the Nasdaq is down 78%, the S&P down 84, and home prices down 87. That's probably a little bit better now. But let's talk real dollars. So in the spring of 20, I moved to Austin here in the spring of 19. I'm a road biker. I met a couple of guys I'm friendly with, and we were bike riding together. Two of the guys are real estate attorneys here in Austin. The other guy is in oil and gas. And we're out riding in the spring of 20. Think about what we were going through in the spring of 2020. And my buddy in the oil and gas business said, hey, I'm thinking about buying a house. Here's a guy my age. He's divorced, was going to buy a house. He could have bought a house. I don't know where. I don't know anything about the house, but it was $300,000. And obviously, the two real estate attorneys told him to do it. I told him not to do it. Now, obviously, that was a bad call on my part. Okay, so that $300,000 house today is worth just under $500,000. Okay, so we're going to round it up to $500,000. I've got to come up with $500,000 to buy that house today. Let's go back to the spring of 20. Where was Bitcoin trading at? It was around $10,000. But I know you put a bid in for the house, and I know attorneys. Let's say it's now the fall, and Bitcoin's now $20,000. How many Bitcoins do I need to buy that house in the fall of 2020? Well, it turns out I need at $20,000 for a $300,000 house. I need 15. I need $500,000 to buy that house today, or I need just under 5 Bitcoins to buy that house today. 15, let me finish. 15, 5 years ago, less than 5 today. Do you see can you see the devaluation of your money?
And for the listener, I think what I want to point out is like, this is my opinion now, my non-professional opinion is like using your own personal like abode where you're living is probably not the very best example because most people don't buy their house for financial reasons primarily. There's lots of other emotional things that might go into that. But I think you could, to Jim's point, I think Jim, you can point out to a car, to a pizza, to like take a dozen eggs, like take anything you want to buy, like take the emotion of your home out of it and
Okay.
just get really honest about like any durable good that you purchase costs 2/3 less in Bitcoin today than it
Yeah.
did five
Yes.
years ago.
For
So
me,
go ahead.
for me, one of the big breakthroughs in my understanding of this is when I realized prices aren't going up, that everything, like, again, a house is still a house, a car is still a car, groceries are, a ribeye is still a ribeye. Prices are not really going up as much as money is losing value. As they
Yeah,
print it and they flood
yeah.
the market, everything, your money loses value. That, for me, that
Yeah.
transition, while small, helped a lot with my understanding.
And
So
losing
we're
value,
actually go ahead.
I just want to clarify. Losing value is tough for some people because like a dollar is a
Yeah.
dollar. But so to me, what made it clear for me is losing purchasing power. Like that to me was like the watershed moment for
Yeah.
me.
Yeah, bingo, John. When I was on in February, I talked about the debasement of our dollar. And it depends on who you listen to. Everybody's got different opinions, but it's somewhere between 8 and 15%. Let's use 8, okay? It's easy. So, in other words, your income, you're making $100,000 this year. What does this mean? A year from now, that 100,000 only buys $92,000 worth of goods. That's the issue. So back to Anthony's very first question. How do you overcome this? Well, you need hard assets. What are hard assets? Well, equities are hard assets. Real estate's a hard asset. Art is a hard asset. Gold is a hard asset. Bitcoin's a hard asset. Diamonds, ammunition. I think all these things will continue to do well going forward. As a matter of fact, 40 years in the bond business, I would advise anyone not to buy long-term bonds here. Okay, not investment advice. But Jim, Trump is going to lower the interest rates. He is. Think about our debt for 1 second here. 23, the market was up 20%. 24, the market's up 20%. As you and I are recording right now, live up to the minute, the Nasdaq is up 20, almost just under 22%, and the S&P is up over 16%. We're going to have 3 years in a row of record returns in the stock market. Historically, it's between 8 and 10. Our gross receipts for the third year in a row will be over $5 trillion. Now, keep in mind, we also have tariff income if the Supreme Court lets that stay. So let's assume that they do, and let's assume we get the tariff income. We're still running a $2 trillion deficit. Okay, they got to cut some. They got to cut something. Okay, let's look at it. Can they cut Social Security? Not for the next 10 or 15 years. Why? You got 76 million baby boomers. You have millions of silent generation. They're not voting themselves out of a check. Good luck with that one. Medicare, not losing it for at least 10 or 15 years. Veterans benefits, good luck cutting their benefits. We just increased the defense budget this year. What else is there to cut? Lunch for the White House? Come on. The only other thing they can cut, it's basic math. The only thing they can cut is interest rates. Why is Trump killing Powell in the media? Why are they doing this? Because the only thing they can cut is rates. So what do they need to do? They've got to get interest rates lower. They have to. But Jim, inflation's running hotter. Yeah, guys, we're 40 trillion in debt. Read your history books. Every nation that's gone through this, you have 5 options. What are these 5 options? All right, glad you asked. You can default. Not happening. Okay, anybody who can print their currency, they don't default, they print the money. Default's out the window. We can do austerity. Great. Go back and listen to the first video and see what I said about Doge.
Okay,
Yeah,
hold
do
on.
I think
Back up. Austerity. What's that for people who don't know what austerity is?
you cut back? You
So
spend less.
you spend only what
You
you bring in.
Yes. Now, you go ahead. Cut our debt, cut our spending by $2 trillion. See what happens to GDP. You'll be in a 1929 recession in a blink of an eye. So you can't do austerity. All right. Okay. You can. How about a production miracle? I know we're going to talk about AI here, but yes, if we get a productivity miracle, go back to the 1800s. The British Empire had the same issue in the 1800s. We got the Industrial Revolution. It bailed them out. Can nuclear fusion come aboard? Yes, maybe it works. Maybe AI works. We'll talk about AI in a minute. I don't think so. Okay, what do most countries do when they're in this situation? They go to war. Okay, let's go to war. We're seeing the results in the Ukraine. Russia's defeated NATO. Look at the bottom line. Do the math. Now, let's go to the end of June. When was the last time you saw a United States president have a WTF moment on national TV? Just go back and watch the tape. Look it up on YouTube. At the end of June, remember the scuffle we had with Iran? We bombed Iran. Israel was bombing Iran. And then Trump negotiated this peace agreement. And then he's doing an interview on the White House grounds. And Israel continued the bombing. And Trump said, they don't know you know what they're doing. Never in my lifetime have I seen a president, no less a public figure, say that live on TV. It made the headlines. What was Trump so upset about? He was upset. He negotiated this deal. But really what he was upset about, the Department of Defense told Trump, look, we can no longer send any more ground-to-air missiles to Israel. We're running low. We can't send any more. Well, we'll just make more. No, we can't, because why? China's not sending us the rare earth materials. Okay, so now let's go to Israel. Israel had less than 2 weeks supply of these ground-to-air missiles. Less than 2 weeks. Well, how many missiles did Iran have? 5 months supply. Look, any second grade kid can do this math. 5 months supply, 2-week defense system. Who's going to win? It's not that hard to see this. And that's why Trump was so upset. So when you look at our debt and you look at reshoring and you look at AI, the math is just not working.
So hold on. I want to
go ahead.
Time out. So because we go back and look at coming out of World War II, massive periods of growth. We got the 60s that you mentioned, the 70s, the 80s, and we have these,
Yeah.
interest rates in the 80s were ridiculous, right? They get into the 20s, I think, something like that.
Yeah.
But over the last, and again, not a historian, but over the last 400 years, the Bank of England or Bank of London, one of those banks, average interest rate at 5%, right? So right now we're at historically pretty normal interest rates. You're saying we got to cut interest rates so that we can cut the payments, right? Mm-hmm. By the way, I just want to give you credit. You came on early in the year and said Doge wasn't going to work because we couldn't do it, and it turned out to be correct. Just want to call that out. You're going to say you said some things wrong. I'm going to say you said some things right too. You got it there. So,
thank you.
I kind of like not knowing all. They say ignorance is bliss. I kind of like just feeling good about things and spending money on Christmas and But I also want to protect my family. Is there a middle ground here? John,
look, bond people are historically pessimistic. Okay.
Is that why you became a bond person?
Yeah, I don't know, because I really think we're going to come out of this much better, but we're going to go through hell first. The United States
what does hell look like? When you say go through hell, because we've been talking on this show a little about the fourth turning. We've talked about Dalio's book where it goes through the cycles. This is a cycle that's repeated itself for hundreds and hundreds of years.
Yeah.
What they call it the fourth turning in the book.
Yes. The fourth turning. Yeah.
They don't call it hell, but it's hard. When I was growing up, they said that good times make for soft people, make for hard times, make for good times, hard people, good times. Like, is that whole?
It all makes sense, John. It all makes sense. Okay,
So what do
but
I have to, what do I prepare my what am I preparing my family for the next 10, 15 years?
okay. Well, first of all, I believe we're in the beginning stages for the first time in over 100 years where the reserve currency of the world is coming into question. You're seeing this in the BRICS. You're seeing this in Russia. You're seeing it in India. You're seeing it in China. What I would encourage everyone to do, please don't take it. If you don't want to believe me, that's fine. Just go read your history. Read Ray Dalio's book. Read The Fourth Turning. Read about the Weimar Republic. Read about Venezuela. Read about Argentina. You know, it's funny, in the last few weeks, I've been to lunch with a guy from India. He's a good friend of mine. And also, believe it or not, I met a guy from Zimbabwe, of all places. I'll bring him on next time. He'll tell you what's going on, where you have trillions of dollars of your banknote basically worthless. Now, do I think the United States is going to go through that type of situation? No. But guys, look, Americans, we have a choice. You can either save the bond market or you can save your country. You can't do both anymore. You're going to have to kill one of them. I believe we're going to kill the bond market. Okay? You have to kill the bond market. Now, don't leave this podcast and say treasuries are going to default. No, they're not defaulting. You're going to get every principal payment, every interest payment you're entitled to. However, it's going to be worth far less than when you invested in the bond.
So that's because, again, that's because the government's printing the money.
Printing the money. Every time they print a dollar, they're devaluing your dollar. You own Apple stock. What happens if Apple comes out today and issues more stock? It dilutes your stock.
Yeah.
That's essentially what the government is doing with our money. They keep printing more money. It's not tied to anything, right? They just create it out of midair. Well, that devalues your current money that you have in your pocket. It's really basic math. So
I need to ask a basic question.
Go ahead.
If hypothetically, if every single country with a legitimate fiat currency increases their money supply proportionate to everyone else, does that change the dynamics of?
No.
Okay.
No. As a matter of fact, they are.
No, that's why I'm asking.
I mean, I look at global liquidity because that's really what drives assets, right? Why is your home up so much? Why is the stock market up so much? Why is gold up so much? Well, China is leading the world in money printing this year. Okay. They're doing more than everyone else. I don't know. Maybe in 26, it'll be another nation. But look, if we didn't print the money, if we weren't making all this money, you wouldn't be as wealthy as you think you are. Okay? Look, to be a millionaire in 1980, if you had $1 million, today you need $4 million to be in the same situation. All right? So look, our debt situation is horrendous. Now, I really want to go ahead.
Before you go on, John, I think to your point, what does hell look like? I don't know that we know, right? Jim doesn't think that in Zimbabwe, but some of the things like more repos on cars are, I think, at an all-time high, or they're approaching an all-time high. Mortgage foreclosures are getting up there close to where they were in like 08, 09. And all of the bankruptcies are way up. There's people, what did we talk about the other day? Like 25 or 30% of grocery purchases are now being financed. Like this is a little bit of...
Whoa. I just want to get the data right.
Sure.
Of the people who are taking payday loans, 25% of those people are buying groceries with them. That's really different than 25% of, okay. Really big, yeah, okay.
So I think these are all symptoms of what Jim's talking about. These are all what happens when the money printing happens, and the Cantillon effect is whether it's the U.S. printing or China printing or whoever, They print it, the politicians benefit, the lobbyists benefit, the big corporations, all the people closest to that money supply, they get the money early. You know who doesn't get it? The waiter, the waitress, the bartender, the factory worker, the truck driver. That's why we have this K-shaped economy, right? So,
Okay, hold on. I know what some of these things mean, but you used Cantillon effect. So first of all, explain what that means.
All right, Richard Cantillon was a Fed governor back 100 years ago. Oh, I'm sorry, I got the Triffin dilemma here. Sorry, I'm mixing them up. Cantillon. Okay, so what he said and he showed in his writings that when the government prints the money, who gets it first? Those closest to the money printer get it first. And by the time it gets down to, Larry Lunchbucket, so to speak, the prices of everything have been inflated already. So the average guy pays the higher price without having the benefit of getting the money like when everyone else did.
So this is classic rich get richer, poor get poorer. That's what we're talking about.
Yeah, if you want to know why there's a equity gap in this country, this is the reason why. All that printed money went to the very wealthy first. And what did they do with it? Well, they bought businesses, they invested it. And that's why the stock market's up as high it is. Should the stock market be up this high? Absolutely not. Will the stock market keep going up? Absolutely. Okay, so I know that's an oxymoron sentence, but look, that's just what's going to happen here. If you look at, I just told you our budget, and we just went over the budget. Can you imagine if the S&P went down 5%? What that would do to our budget? It would blow it out.
So people that say things like, well, we should just kind of take our medicine and let things go down, that's one way of handling it. A different mechanism is inflate the money supply.
Mm-hmm.
You have the same purchasing power reality as if you let it go down, but it doesn't feel as bad, which can be, I guess politically, it's at least I don't agree with it, but at least it's understandable why somebody would choose that route, right? Because they're not going to like alienate their voting base like that. I understand the incentive, even if I don't agree with it. Right?
Yeah, first of all, the politicians aren't going to do it, but let's assume they did. All right, I don't have this is going to be ballpark numbers. You would have to cut our spending by at least a third. So instead of spending $7 trillion a year, you're going to be spending under $5 trillion. Okay, what do you think that's going to do to our GDP? It's going to blow it up. What do you think that does to our Treasury market? You're going to have failed auctions. All right, it'll blow up our debt. There's absolutely no way we can do that. The math doesn't work. You're going to tell all the boomers and all the silent generation, your Social Security, your Medicare benefits, the VA benefits, you're going to cut them by a third. Good luck with that. Try getting that through Congress. Look, I tell every person this. If you're over 80 years old, you're good. You're going to get all your Social Security. You're going to get all your Medicare. Why? Because we got the votes. 10 years from now, 15 years from now, when the youngest baby boomer is approaching 80, and a lot of these people have passed away, well, then the millennials and Generation Z will have their say. So if you're a young boomer, I would not think that you're going to get Social Security and Medicare benefits for the rest of your life. I just don't see it. The math doesn't work. So if the math doesn't work, regardless of what your biases are, regardless of what you think, 2 + 2 has to equal 4, and it doesn't. And that's the problem. Our debt is the issue. That is the underlying problem here. And look, there's red flag after red flag after red flag. And I can spend the next hour going over this. But I know we're getting a little short on time. But look, there are so many red flags in our Treasury market, in our bond markets.
Okay, so I'm trying to take it down to my level real quick. So what I'm hearing, like, buy hard assets, check. I heard that message, right? I think what I just heard, please firmly correct me if I'm wrong, buy hard assets with leverage if you can, because if you can borrow money with today's cash, right, and then pay it back with tomorrow's inflated cash, you end up paying less for that hard asset. Is that true?
It's true. I would not do it, though.
Okay, why?
Why? John, I personally believe these next 6 months could be really, really dicey.
So debt's bad in that case.
Yeah, yeah. I
Okay.
would not. I would not. I mean, just look what's happened to Bitcoiners who leveraged their Bitcoin. They got taken out.
Yeah.
Look, right now is not the time to be levered. You know, you want to be unlevered. You want cash on the sidelines. Look, if we go back to April, we had a 25% drawdown in the stock market. Great time to buy. You're up 40% since those lows. Okay, you want to be able to buy there. I don't believe the stock market can stay down for a long time. Could it go down 20%? Absolutely. But the Fed, the Treasury, cannot let the market have a 22 again because it'll kill their receipts. You got your capital gains receipts, which was $500 billion in 22. You got your RMD receipts, required minimum distributions that all the retirees got to take out. That was a lot lower. That'll cost the government $600 billion. And at a $2 trillion deficit, what do you need to do? You got to issue more. You got to issue more bonds. No one's buying our bonds.
So
Look,
is it an okay time to buy a house then? I get don't buy
no,
get Bitcoin lever.
no. Look. People ask me all the time, should I buy a house? If you're 35 years old, you got a wife, you got a couple of kids, I got it. I understand. I did it. You guys probably did it. Am I buying real estate just to buy it? No. Look, they're going to fix real estate with the lowering of interest rates. So that to me is going to get fixed. You bring those rates down, you bring that 10-year down to 2%, you watch what happens to the real estate market. You want growth in this country? You know, you bring that 10-year down 2%. And speaking of the 10-year, remember what Trump and Bessent said on January 20th. Judge me by the 10-year. The 10-year on January 20th was around 4.25. It's 4.17 right now. Do you think that's an A+ grade? I don't.
I don't know what it would be. Would A+ be 2% or 10%? Like what, up or down? Like what would be good?
Look, I think Bessent was looking at 3.5, 3.
Okay.
We're not even close. So if I had a grade, okay, remember what he said. These were his exact words on the 20th. Judge me on the 10-year. 4.25 on January 20th, 4.17 on December 8th. It's not working for me, guys. It doesn't matter if I voted for him, if I like him, if I think he's the greatest Treasury secretary in the world. The math doesn't work. It's just basic math. It just comes down to math for me. How did he do? 8 basis points in 11 months, 10 months, whatever it is? I don't think he's gotten rates down to what he thought he was going to do. Now, going into 26, they're coming down. If you're a trader, I'm not. If you're a trader, so some financial people asked me a few weeks ago, Jim, if you're right and the Treasury goes from 4.17 on the 10-year to 2 on the 10-year, don't you think that's worth a trade in bonds? Go ahead. Go do it. It's like picking up a nickel in front of a steamroller. But let me ask you this. If the 10-year Treasury at 4.17 goes to 2, that means liquidity is in the market, okay? Expanding liquidity. What happens to the equity market? What happens to gold? What happens to housing? What happens to Bitcoin? What happens to art?
For people listening only, he's pointing up with each one of these.
These assets will go through the roof.
So wait, but you just told me not to buy a house. Now I'm confused.
Yeah, look, because I don't think real estate is, look, for the last 40 years, when you have a bond bull market, you're going to make a lot of money in real estate. When it's a bear market, you don't make as much money. Even if the 10-year goes to 2%, what is this going to cause? Inflation. Inflation could be 4%, 5%, 10%. The government doesn't care. They got to devalue the debt. John, you talked about the 40s before. What's the difference? Here's the difference. We're 120% debt to GDP. We're running a 7% budget deficit. And we have a net international investment position of a negative 80%.
Yeah, I don't know what all it means. I think what that means is I got to pay more in interest payments that I can't spend on improving infrastructure. Is that what I'm
Okay.
hearing?
Okay. Okay. The big confusing part there is a net international investment position. Negative 80%. What does that mean? John, you're an individual, you and your wife. We're at the end of the year here. And you had a major health scare during the year. And it cost you an extra $50,000. And you say, and you and your wife sit at the table there, and you say, okay, hon, what are our options here? Our options are we can pay it back on the installment plan, we can borrow money and pay it back, or we can tap our 401k, we can tap our home equity loan to pay it off. You have the money. That's a positive net international investment position. The United States has a negative. Japan has a positive 60% international investment position. They got a problem with money, they'll just sell some assets. I'll cover it. The United States doesn't have that. In the 1940s, our debt to GDP was 30%. In the 1980s, it was 30%. It's 120 and going higher. The math just doesn't work.
Okay, so real estate's going to go up, gold's going to go up, Bitcoin
Yeah.
you think is going to go up, but of all those things, I think I heard you say diversified portfolio equities are
Yeah.
good. Careful
Yeah.
of bonds is I think what I heard. So and then cash on the sidelines so you can buy when there's buying opportunities.
Yeah, I would take any long-term bond and convert that into short-term bonds. Okay.
Okay.
Nothing out more than 3, 5, 10 years. Wouldn't have anything there. Look, the government's telling you you're losing money. Think about this for a second. The government's issuing debt, and how many rare earth deals have they made over the last couple of months? They're buying rare earths, Australia, a big deal there. They're buying property in Nevada. They are doing every rare earth deal under the sun. So they're issuing debt to do this, and we're buying that debt? You see the oxymoron there? They're buying metals, we're buying their debt. It doesn't work. Do what they're doing. Do what central banks have done for the last 12 years. I mean, it's not rocket science.
So kind of follow the money, right? Like my
Follow
kids
the money.
my kids were joking. They're like, Dad, we want to invest in those ETF funds that follow what the senators and the House of Representatives do because they know what we don't know. I was like, that's really smart. And I'm glad that you figured that out at a young age.
Yeah, I mean, there's an ETF with the Nancy Pelosi fund. I know she's stepping down, so maybe we won't know anymore. But yeah, you can do it.
Yeah.
Jim, can we go back for a point of clarification? You were talking about the interest rates earlier, right?
Yeah.
And it went from 4.25 to 4.17. But the Fed rate cuts this year, I think what most people hear, right? If rates are at 4.25 and they drop a quarter point, the 10-year should go down a quarter. I think that's what people assume, but that's not what's happened.
That's not what's happening.
3 or 4 interest rate decreases this year, right? 3?
Well, let's go back to last year, Randy.
Yeah.
Last year, the Fed cut 75 basis points in September and October. The 10-year yield went up. What? Okay, so they're doing the same thing now. Okay, they're doing it again. It's like they didn't learn their lesson from last year. So they're cutting rates. Again, why are they cutting rates? I think Powell's doing it reluctantly. Whoever the new Fed chair is coming in, they're going to do it very aggressively. And, look, why are they doing it? It's the only budget item that makes sense to cut. They're in a corner.
So
they are stuck.
What I want you to address for listeners is they're cutting rates, but we don't watch the 10-year and the 30-year going down.
No.
Mortgage rates aren't going, even though they've cut last year 75 points, this year 75 points, you would think mortgages would be down 1.5%, but they're not.
Oh, they would be down from 7, right? They would be like 5.5 or something.
Right.
Yes.
So
that's logic.
Explain that market dynamic. Why is that not happening? What is happening instead?
Okay, so your mortgage rates, like most things in the world, are tied to the risk-free rate. What's the risk-free rate? The 10-year Treasury. Okay, see, the Fed controls the short end of the market, the 1-2 year market. When they lower the discount rate or the overnight rates, they're affecting T-bills, and even a 2-year bond. They don't control the 10-year rate. That the market decides. And the mere fact that for 2 straight years, the Fed has cut 75, assuming they cut 25 this week, which all consensus believes they will, that's 2 straight years, 75% rate cuts, 75 basis point rate cuts, and the 10-year, it's not going down. Why? I mean, even if you don't understand it, even if it doesn't make sense to you, you must come to the conclusion that something's not right. Something's not working. And what's not working is the debt markets. Again, we're in fiscal dominance. This is when the debt drives you. You don't drive the debt. Those days are over. We've passed that Rubicon, so to speak.
So that's maybe to sum it up. That means Japan, China, investors, etc., are not buying as many. There are not as many bids or people wanting to buy our debt, and we're having a harder and harder time unloading it. Is that a good way to sum it up?
You can see it in every instance. Jack Lew was President Obama's Treasury Secretary. In 2014, he was rolling on a weekly basis $100 billion in T-bills.
What does that mean?
In other words, they were issuing $100 billion in T-bills every week because they had to pay off the old ones and issue more debt to pay their bills. Right now, Bassett is issuing $550 billion in T-bills on a weekly basis. This is unheard of. This is ridiculous. $550 billion. It's a 5-fold increase. Why? Because they can't issue 10-year and 30-year bonds. They can't. No one's buying them. Central banks, for the last 12 years, have stopped buying our debt. They're buying gold. Okay? If you think you're smarter than the central banks, so be it. God bless you. Okay? So who's buying our debt? Well, in 2014, the Fed mandated through the money market funds, if you remember that fiasco from the great financial crisis, they would only back government bond money markets. Okay? They relaxed the SLR agreements. That's the supplements leverage ratio for banks, so they could buy more bonds. And they just did it again. Okay? They're doing Treasury buybacks. I covered that in the first part. Go back and listen to it. What are Treasury buybacks? Why do you need to do it? Janet Yellen started this in 23. Besant picked it up. He doubled it this past spring. Why are we doing Treasury buybacks if it's the largest, most liquid market in the world? Look, there's a problem, guys. You don't have to understand the problem. You just have to know there is a problem. And I showed you through that.
I think that's the key. Hold on. So there's a problem. I don't fully understand the problem, but I know enough to know that bonds carry a different type of risk. So short-term bonds, if I want bonds, that's what I'm hearing. Equities, hard assets, that's a thing to think about for the future, right? So and then be sensitive to purchasing power, that you may be making more and more and more money. Inflation is being reported by different groups, right? That is an arguable number, that people have different incentives for telling you different things. All that really matters is what you're purchasing with your money.
Absolutely, John. Look, everybody's got a story. You go to your local HEB, and the things that you buy on a weekly, monthly basis are all up in price. You know, your rent is going up. Even though Austin has got a lot of empty buildings, your rent is going up. Your taxes are going up. I mean, it's not going up 2%. It's going up 3, 4, 5, 10%. Take your pick. Eggs. Try getting we mentioned ribeyes at the beginning of the show. Get a decent ribeye and tell me how much higher that is than what it was just a few years ago. So look, these things are key things, John. You brought up a good point here, and let's start to wind up.
I was real quick at the restaurant. I got a mocktail. I looked at the mocktail, so the non-alcoholic drinks, $16 for a non-alcoholic drink at a restaurant the other day. I was like, I'm gonna have some water.
I mean, really, it's insane. All right, so guys, we're going forward. We're going to go into 26. Have me back in 3, 6 months, see if I'm right or wrong, whatever. Here's some things I believe will happen. You're going to get a new Fed chair. That's a given.
What does
He's
that
going to
mean for
be
me?
he's going to be dovish on rates. Rates are going to come down. I believe they're going to get the 10-year down. Okay, there's other things that they can do, and I think there's some things that'll happen. Here's something else that's going to happen. By the end of the first quarter, Trump better have everything he wants to get done. Because what are we going to start talking about on April 1st? Midterms. And that's going to drive the bus for next year, towards the end of next year. And if he loses the House or Senate, he's a 2-year sitting duck president. All right. Next July, it's our 250th year. Just think about who's the president. Think about what he wants to do. Read Judy Shelton's book. She believes they're going to do some type of gold-backed treasury bond. I don't know, but it's interesting. So indices that I like to follow. These are some things you guys can follow that are very, very important. The Treasury Move Index. Go on ChatGPT, put it in there, Treasury Move Index, and it'll show you. I don't know what, I use Bloomberg, so I get it on there, but you can track this. And this is the volatility index. So the guy who invented it just recently passed away, but think of 100 being par. When it goes over 100, that means liquidity is drying up. Okay, that means the dollar's going to get stronger, the market's going to go down, and the treasury market's going to basically malfunction. When it goes lower, there's ample liquidity. That's a great thing to follow. The spread between corporate bonds and treasury bonds. It's very tight right now. When that moves out, that's usually a sign that money's getting tight. I would watch oil. Oil is a key commodity. Right now, it's trading around $60 a barrel. It's too low. Shale is rolling over. What do I mean by rolling over? You know, they shut down those rigs. If they can't make money with shale, we're going to cede the oil markets to Russia and Saudi Arabia. I don't believe it's going to happen. So watch oil. Look, I think going where I want to be with assets. Look, I think gold is a very interesting play here. Hundreds of billions of dollars of gold have come into this country over the last year. Where's it going? Who has it? You know, all financial firms have to report every quarter. We call them 13F filings, 13F like Frank. It's a mandatory filing that everyone has to file, every financial firm. Okay, so you have to report your buys and sells every quarter. No one's reported buying of any gold in any large quantity. Okay, well, common sense says to me that I think I know where that gold is going, and I believe at some point in time they're going to have to revalue gold. So I think gold. Look, I think Bitcoin going to be a little rocky here. Could be a little rocky. I think we could get some kind of downdraft here, even in the stock market. But that's to me a buying opportunity. The market goes down 20%. Use your cash. Use your short-term bonds. Add into that scenario. The Fed needs a higher stock market. That's it. There's nothing else to discuss. Whether I'm right or wrong is irrelevant. The Treasury needs a higher equity market. They got to pay the bills. We can't pay them now. Just do the math on that. $5 trillion in receipts, $7 trillion in spending. What happens if the stock market goes up 2% a year? Where are we going? It's horrendous. It really is. And we're spending trillions of dollars on AI. Right? I read the other day where over the next 3 years, AI needs $3 trillion to keep losing money. Think about that for a second. So there's a lot of things that we're watching, but look, I believe it's hard assets. Look, my two largest positions are Bitcoin and gold. That's where I think it's going to be. Equities. I think there's going to be pockets of equities. I think will do a lot better than others. I think we have a problem with the grid in this country. We don't have enough grid for this AI. You look at all these data centers. They don't have the grid. NVIDIA. You might have heard of NVIDIA. It's our largest company in America. In Santa Clara, California, the two data centers that NVIDIA is relying on for power are sitting dark. There's no grid. Think about that. Think about that. Do you think they're going to have to expand our grid over the next 3, 5, 10 years? Well, if you don't, then don't do it. But the math says to me that we need more power generated. Well, I don't know if it's nuclear. I don't know if it's wind. I don't know if it's solar. I don't know if drilling out in the ocean. I don't know that. But I know we need more grid. So these are things I would be looking to do as we go into 26, and key things that are going to say to me, hey, and by all means, there's some people I follow. I mean, if liquidity is expanding, the market's going up. And I really believe right now what we're looking at in this country as we sit here today, I think we're looking at the mother of all crises. Because right now, we need the Fed to start printing money. If we don't, because we are seeing many red flags, whether it be the TGA, the repo, the reverse repo. I mean, we can get into all this, but right now, I'm looking at this before printing, during printing, and after printing. And I think this is all going to hit the fan in the next 2 to 6 months. By next summer, we're going to have a good idea. Because there's no way Trump is going into the midterms without shooting some guns. It's just basic math. No president does. So be prepared.
It's going to be interesting. We'll have to come back and take a look in a few months how it all turned out based on some of the things you've said. That'll be very interesting.
I think so, John. I'll be interested myself. And, look, I think some of the things we talked about in our prior episode worked out. I didn't get everything right. But, and I'm not going to be right on everything. But I do know this.
Definitely take the $20 bills out of your pillow and put them into something that's a hard asset. That's what I heard.
Definitely.
Jim, what do you think the growth rate will be over the next 6 months to a year in this country?
It has to be higher than our interest rates.
Right.
All right. Because we have to inflate the money away. So if the 10-year Treasury is at 2, the growth rate has to be higher.
Gotcha.
Has to be. It's just basic math. If the 10-year Treasury is at 4, you need a higher than 4% growth rate. If it's under that, we got a problem. That's a great question, Anthony. If our growth is not above where interest rates are, we got a major issue on our hands.
I mean, that's the only thing that we can do to slow the increase in the deficit. And we would have to grow at 10% a year for 4 years to cover the $5 billion to $7 billion. So, be tough. That's obviously unlikely, but it's going to be interesting to see what the next year brings.
Well, let's keep this conversation alive. I think we come back in a few months, Jim. We'll bring you back on. We'll say, here are the things we said we should do. If you did that, here's how it turns out. If you didn't do that, here's how it turns out. And definitely take your 20s from the pillowcase and get them into some kind of hard assets somewhere. So it's like I got $40 going into gold later today.
Hey, you could do it at Costco, right?
Yeah, that's good.
And by the way,
Randy, you want to take us home?
To give Jim his flowers, I was referring back to just an AI summary of his predictions from January, February, whenever that was. They're pretty spot on. They haven't all come true, but like one of them that hasn't come true is he said there's a good chance of a black swan event. And A, he said it's a good chance. B, I don't think we're necessarily out of the water. Like that could still happen. So if you
and C, predicting black swan events makes them not black swan events.
That's true.
Yeah.
I will say this on the Black Swan event. I believe with all my heart it's coming out of the bond market. Somewhere somebody's over leveraged, issued too much debt. So that's where I think it would come from.
Oh, great work, man. This is great.
It's fun.
All right, guys.
All right.
Thanks, Jim.
Always a joy.
Yes. Thank you so much, Jim. Merry Christmas. And listeners, as always, thank you for downloading.
Have a good
Thanks,
one.
everyone.
Happy holidays.
Thanks, Jim.
Same to you, Jim.
Listen and subscribe to the podcast wherever you get your podcasts. Click follow for more content like this, or go to talesofabundance.com to join our community and get free tools.